Welcome back to The Explainer. Today, we're diving into a really fascinating market mystery, specifically surrounding LXP Industrial Trust. If you follow REITs, you already know the drill. Sometimes the market's reaction to earnings guidance feels totally disconnected from reality. Well, LXP's latest update, it is literally a textbook example of this disconnect, and we're going to figure out exactly what's going on.
So, get this. LXP just put out their 2026 adjusted FFO guidance, that's funds from operations, and they're projecting a range of $3.22 to $3.37 a share. Now that completely crushed the FactSet estimate of $3.07. Crushed it. You've got this massive beat on projected earnings, and yet the stock curiously dropped 7% right after the news. I mean, no way, right? Why on earth does a company beat expectations that handily and still get punished by the market?
Okay, let's dive into this and look at our roadmap. We're going to hit 5 key things to solve this paradox: the 2026 earnings surprise, executive skin in the game, the trade policy pivot, operational wins and buybacks, and finally, big box concentration risks.
Starting right off with Part 1, the 2026 earnings surprise.
So looking at that near-term frame, that $3.22 to $3.37 guidance obviously paints a super strong earnings picture on the surface. But you know how it is, investors are incredibly forward-looking and cautious. The guidance range for 2026 was actually relatively wide, and that wide range left analysts wondering, well, what happens if leasing momentum suddenly stalls out, or what if occupancy drops? It basically baked a subtle layer of uncertainty right into the good news, making the market just a little bit nervous about how stable those projections really are.
All right, moving on to Part 2, executive skin in the game.
Now, we all know corporate proxy speak usually hides the real story, but here, it actually translates into some serious, mandated accountability. According to their 2026 proxy statement, LXP has this super strict retention policy. The CEO literally has to hold company stock equal to a massive 6 times their annual base salary. The next top 3 execs, 3 times their salary. Even the 5th top executive has to hold 2 times. This isn't just some nice suggestion, it is a hard rule designed to guarantee true skin in the game for the leadership team.
To put some actual dollars behind that policy, CEO T. Wilson Eglin is sitting on nearly $11 million in unvested equity. That's a massive chunk of change. It proves management is highly, directly incentivized to promote long-term equity ownership. Actually, scratch that, their own personal wealth is entirely locked into the long-term performance and stability of this trust. They are fully in the same boat as the shareholders.
Which brings us to Part 3, the trade policy pivot.
Let's rewind to the start of 2025. LXP's planned strategy was pretty aggressive. They wanted to focus on capital recycling and ramp up exposure through new build-to-suit projects. But then, bam, intense international trade policy uncertainty hits. The proxy statement actually refers to this period as Liberation Day, which is kind of a wild term. This intense external pressure forced LXP to make a major pivot. Instead of that aggressive expansion, they had to totally prioritize debt reduction.
So what did that defensive pivot actually look like? Well, they offloaded 8 non-target warehouse facilities for $175 million, but really pumped the brakes on buying, picking up just 1 target facility for $30 million. They even sold off 3 target facilities, which included 2 completely vacant developments for another $214 million. Basically, leadership looked at the chaotic global trade environment and decided, yeah, paying down debt is a much safer bet right now than expanding blindly.
Let's shift gears to Part 4, operational wins and buybacks.
And this brilliantly illustrates what's going on with their ground game. They recently wrapped up 0.7 million square feet of new leases and extensions. But the absolute jaw-dropper here, the rent spreads. They hiked base rents by a staggering 34.1% and cash space rents by 24.3%. For industrial real estate, pushing rent hikes that high on new leases is just a massive, undeniable operational win.
At the exact same time, they were working behind the scenes to bulletproof the balance sheet. They managed to extend their maturities and, super importantly, reduce the pricing on a $600 million revolving credit facility plus a $250 million term loan. They were systematically shoring up their capital structure, basically battening down the hatches for any kind of economic weather.
Which freed them up to make some really strategic moves. Case in point, they recently repurchased and retired roughly 325,000 common shares at an average of $48.70. But here's the thing, this wasn't just some random quarter-end flex. This was actually the finishing touch on a much larger, long-term initiative to reward their shareholders.
That's right, the whole shebang was a massive $223.45 million buyback program, effectively taking over 23 million shares totally off the market. This is absolutely crucial to understand. By tightening the share count that drastically, any future FFO generation is spread across way fewer shares. When you pair this completed buyback program with that new wide FFO guidance we talked about earlier, it fundamentally changes how investors have to calculate future cash generation per share.
Finally, Part 5, Big Box Concentration Risks. So the crucial point is this. Operations are crushing it, management is fully aligned, but to really answer why the stock dropped, we have to assess the core thesis of owning LXP. When you buy into this trust, you're buying into a very specific asset class, and that comes with its own unique structural set of rules and risks.
It's kind of like a giant balancing act. On one hand, your core catalyst for holding the stock is execution. You're betting LXP can keep snagging those huge mark-to-market rent opportunities. But the flip side, the key risk, is their concentrated exposure to big box vacancies. And the thing that magnifies this risk is LXP's reliance on single-tenant properties. These aren't multi-unit spaces. They rely on just one massive occupier. So if even a handful of these giant tenants decide to pack up at the end of a lease, the hit to LXP's cash flow would be severe and immediate.
That downside risk of a single giant vacancy, it's immense. And honestly, that is exactly what the market was pricing in when they saw that wider than expected 2026 forecast range. To hold LXP, you absolutely have to believe their leasing momentum will outrun those structural risks. So I want to leave you with this provocative question to think about. Are LXP's massive 34% rent spreads and brilliant balance sheet maneuvers enough to outweigh the cascading risks of a single big box vacancy? The stakes are high on both sides, making this a fascinating balance of risk and reward. Thanks so much for joining me to unpack all this data today, and I'll catch you in the next explainer.